This is C3.ai on the monthly chart, and it was shaping up to be a great year for shareholders of C3.ai as they were riding the coattails of NVIDIA and the AI space. However, price has pulled back uh, nearly 50%, probably a little bit more than 50%, and it finds itself at a key level. Let's show that a bit better by using a horizontal rectangle. So this was resistance, now serving as support. Kind of going down to the weekly chart, you can see how price hit this weekly level. It's hard to see, but pretty much the last candle, it was an extended range red candle on low volume. So the price structure wasn't the greatest, but um, it was also supported by what was previously support um, up at the $45 level, which became resistance. So again, price now currently is at a level of support, which was resistance in the past. So should you be a bull and buy, or should you be a bear and continue to sell? How much more downside risk is there in the stock? Well, before we continue with the analysis, let's look at this article. So again, it's been a roller coaster ride for the stock, rising impressively in the first half of the year before pulling back significantly over the past couple of months. Shares of the stock are down 44% since the beginning of August. Company's fiscal 2024 first quarter results, which were released last month, didn't help matters either, as its growth wasn't solid enough. C3.ai doesn't expect to deliver a profit in the new fiscal year, which it was anticipating earlier, strengthening the bearish argument against investing in the stock, considering its steep valuation. Now, that valuation has come down since the pullback, but it can still be overvalued at current levels. C3.ai stock is up 120% in 2023 despite its recent pullback. So again, a good year still thus far, but it was better. That surge has mostly been driven by the growing hype around AI and not by the company's actual performance. For instance, the company's fiscal Q1 revenue increased just 11% from the prior year period. That's quite a modest for a stock trading at a rich 10 times sales. Wall Street analysts are pointing out that the company isn't benefiting from the growing adoption of AI applications. That's not surprising, as the market for AI software is expected to grow at an annual clip of 23% over the next decade. Therefore, C3.ai is underperforming the industry in which it operates. All right, so what's the bull case? Company started charging customers for its service on a consumption-based model from the beginning of fiscal 2023. It used to charge them on a subscription basis earlier, which gave it greater revenue visibility since it was able to look and lock them in for longer contracts. Management estimates that the consumption revenue model will take another couple of quarters before it starts scaling up and driving growth for the company. So revenues increased just 5% in fiscal 2023. So its forecasting for the current year points towards a much stronger growth. More importantly, C3.ai points out that its sales pipeline has been improving at a nice clip post the transition. On a September earnings conference call, the CEO said that C3.ai has closed 12 Gen AI agreements and has a pipeline of more than 140 qualified generative AI enterprise opportunities. So, could C3.ai eventually regain its mojo? It's possible. It's very possible. It's going to, again, rise and fall with NVIDIA, and NVIDIA is off its all-time highs as of late. So, although price is at a support level, you have to continue to look at the price action on NVIDIA. Let's go down to the daily chart. And price is below a rising 200-day moving average. So typically anything below is bearish, anything above it, it's bullish. Now you're about to get this depth cross over That's where the 50 crosses over and below the 200-day moving average. That won't be a good sentiment for the technicals. So again, what I would like to see is NVIDIA turn around, and potentially when that happens, you will also see the stock on C3.ai turn around. In addition, you'll get this rounding effect of the moving averages. Right now, they're all kind of, well, the momentum ones are pointing down, so that's not a good down, as there could be still more downside risk. So here's the level of interest that I'm looking at, and that's going to come in at the $20 level. So let's kind of denote that, where you have a strong rally in price on decent volume. So you had some basing and then the rise in the price, which took it to $48 back in June. So this could be a level worth watching if this support resistance band gets broken. This could be a bear trap for those resistance support traders. So let's just put in, we're going to call that daily buyers at the $20 level. What I like about that as well is that a round hole psychological number, and you potentially could put a stop below the low. We'll say we'll just say at 16. All right, just for again, just I like the round numbers. So you'll be risking $4. Maybe go to break even at a 1-to-1 or 2-to-1. Maybe first target at 30 and second target at 40. Thanks for watching. Subscribe. Please like the video.